What is the gross domestic product, and how can I use the data for an optimal trading experience? Hi, I am Mahmoud Alkudsi, ADSS Senior Market Strategist. In this video, we will explore the concept of gross domestic product and discuss its impact on central bank policies and on market sentiment. So let's get started. Gross domestic product, or the GDP, is the total monetary value of goods and services produced within a country borders over a specific period, typically measured quarterly. How does GDP data move market prices? A strong GDP data indicates a healthy and expanding economy, and central banks use this data to set monetary policies. For example, a high GDP growth might lead to higher interest rates to curb inflation, while low GDP growth could prompt rate cuts to stimulate the economy. In stock market, a positive GDP growth usually leads to increased investor confidence and likely higher earning for companies, leading to raising stock prices. A weak or negative GDP growth, on the other hand, indicates economic troubles, leading to lower corporate profits, as such, declining stock prices as investors become more cautious. In currencies market, a strong GDP growth attracts foreign investment and therefore increases demand for the country's currency, and potentially driving up its value and vice versa. In commodities market, a strong GDP growth indicates a higher industrial and consumer demand, which can boost commodities prices such as oil, metals, etc. While weak GDP data can signal lower demand, leading to falling commodities prices. GDP growth can also hint to raising inflation, which impact commodities prices as investors seek to hedge against inflation. So, how can you use the GDP data when you trade? First, keep track of when GDP data is released and mark these dates on your diary. Second, analyze expectations versus actual data. A significant deviation from expectations can lead to market volatility and trading opportunities. To check the data release and expectations, please refer to the ADSS economic calendar from the link on the screen. Third, use GDP data in conjunction with other economic indicators such as unemployment and inflation rates to get a comprehensive view of the economy and make more informed trading decisions. And last but not least, apply technical analysis tools to historical GDP data and price charts to identify trends and potential entry and exit points for trades. So, to summarize, by understanding and leveraging the GDP data, traders can gain valuable insights into economic conditions and make more strategic trading decisions. That's all for this video. Thank you for watching, and I'll see you in the next video where we will continue to learn about different aspects of trading.